We are on the video for session number 8, and we are on other financing alternatives. We spent a lot of time looking at angel funding and venture capital funding, but we're going to pull together all the other various approaches in one chapter. And we've covered some of these along the way, but it's good to put them all in one place at one time. So in addition to having equity financing from angels and VCs, we can have debt. And at some point along the stairway to heaven, you're going to have debt made available to you. Probably not at the beginning, but as you progress through angel into VC, you're going to be attractive to bankers to have debt. And so we're going to cover that. Second learning objective are government programs. As we saw before, the SBA is charged by Congress to spur the development and the survival of small businesses. And we're going to look at some of the specific ways that the SBA implements that mandate. Third is venture leasing, and we're looking at venture leasing and venture lending as variations on normal leasing and normal lending. And we'll talk about the differences and why these are perhaps viable alternatives. Next, and finally, we have direct public offerings, where it's not through the traditional IPO process to the SEC. There are other ways to go have wider shares held by the public. So first, and when we look at debt for ventures, we have commercial banks and we have venture banks. And let's look at the distinctions. You might be able to guess them. Commercial banks are the ones we know. They tend to be very conservative. They look at the borrower's ability to repay, the valuation of the assets, should they repossess them and try to convert those assets into cash in case you default. That's what bankers do. You're probably familiar with that. Venture banks are on the more risky fringe of commercial banks. They still are commercial banks, but their difference is that they look for the rate of return as part of what they're seeking. They're seeking a successful long-run business that can become a major client of the banks, as opposed to a couple $1 million loan. They're looking at full-fledged companies, hopefully that become publicly traded companies. Furthermore, in addition to their normal return of getting interest, they may accept warrants. And as we saw before, warrants are a form of sharing the equity appreciation with a third party. In this case, the venture would share some of their upside with the bank. So there are 5 C's of credit analysis, and these have been around for decades, and they still hold true today. First is, what is the capacity of the borrower to repay? Notice I said the borrower and not the person. The borrower, in most cases for venture, would be a legal entity like a corporation. So how well suited is the corporation in repaying that loan? It may be that the corporation's not very capable, but the borrower's owner is. So that's where we get into personal guarantees, things of that sort. But the first is looking straight to the main entity that signed the contract, and that is the borrower, and in most cases, it will be a corporation. Next is capital. How much capital is invested in the business? First, if there's a large amount of capital, then you have real dollars and assets in the company that are put in before the bank makes their loan. It also is an indicator of the amount of confidence and skin in the game, if you will, that the owners have in the business. So both in terms of the reality of dollars put into the company, as well as indication of the level of commitment and risk taken by the entrepreneurs themselves. These are important for the banker to consider. Third is collateral. We know what the collateral is. It's an asset that is pledged to guarantee to the lender that their loan will be repaid. And the flip side is, if you don't repay the loan, then the lender has the right to possess or repossess the asset that was financed or act upon the collateral. A collateral could be different from what you finance. So you may borrow money to buy a factory, but you may have additional collateral such as your personal CD portfolio at a bank. So the loan was made to a corporation to enable them to buy factory equipment, but the collateral that was pledged to support the loan was your personal CD account. So that's the distinction between a collateral and what is financed. It is the additional assurance, security if you will, provided to the bank to give them comfort that even if you don't pay them back, they have another way to get repaid. The next are conditions. These are conditions of the loan, like what is the purpose of the loan, what is the risk inherent in the loan. So these are the details of the actual financing. And finally, character. This is a character of you as a potential client of the bank, and your management team, your founders, your board, etc. They're looking beyond just the corporation as additional assurance that you're good for the loan. So these have been around, as mentioned, for decades, and they're they're still true today. So we'll want to look at loan restrictions. These are some of just a few of the restrictions that are likely to see in a bank loan. And bank loans are about this thick, so there's a lot of restrictions. So first is you have a responsibility to maintain records for the company. These are financial statements. These are also legal papers and incorporation papers and contracts with third parties. So it's your responsibility just as a steward of assets to take care of records and to provide financial statements on a regular basis to the bank. Next is there may be limits on the total debt you can have. Now, this is maybe not from a bank, but the bank may say, we will lend you $1 million, but you cannot borrow any more than $5 million total for the entire company. And so this is to protect the bank that you don't over-lever your company and put everybody at risk. Third is they may have restrictions on payments you make for dividends or other payments you may make to owners or investors. It would be silly, for example, for you to have a company that's a bit in trouble, borrow $1 million from the bank, take the $1 million and just pay it out to all the shareholders as a special dividend. That would increase the risk of the company for an already fragile company. So the bank does not want to fund you to just give liquidity to your investors. If you're in trouble, the bank wants you to use their money to make the company healthier. So this is a common restriction. Next is restriction on sales of fixed assets. For example, if the bank lends you $1 million, but then you run out and sell all of your factory equipment to somebody, well, that kind of, again, weakens the company and also the bank's position as lending to a viable company. Selling of all your fixed assets or specific fixed assets are against the best interests of the bank, and they will restrict it. It doesn't mean you cannot run the business in the way it should be run. It does mean that you must have the bank's permission, which means you have to make your case to the bank why you're selling all your assets and why they shouldn't feel bad. So it gives them the right to listen to the story and review it and approve it or not. So it's significant power to the bank, but you can see the concern that you might do things that are against their interests. Next, there would be ratios. We've seen ratios all the way from Mod A to now, but these are ratios that are protecting the bank. So the bank may require that you maintain a certain profit margin, or maintain certain current or quick ratios, or maintain certain gross profit margins or expense controls. Whatever the ratios that they deem important enough to put into the contract, you're now bound to this. Now, what happens if you miss? If the current ratio is supposed to be 2.0 and you drop to 1.8, it probably doesn't mean that your loan is called immediately due and payable, but it means, again, that you have a conversation with the bank with what's going on. And they have the right to not like it and have further remedies that will fix it, but it's more checkpoints along the way to make sure they have ways to have the dialogue or have some kind of control before everything really runs into the wall. And finally, there might be certain tax and insurance payments that must be made because the bank doesn't want you to be in default with the government or with insurance because they're at risk. If a insurance policy lapses, you are no longer covered. If you have a fire at the plant, then there is no insurance and it's a major loss for the company. So they're going to want to make sure that your insurance policies are in force and paid up to date. Likewise, with property taxes, these have precedent in most cases over the bank. So the bank doesn't want anyone to have a liability ahead of theirs. So they have a restriction, so you must be current with your tax payments. Otherwise, you're jeopardizing the company. And furthermore, the bank will likely be subordinate to the rights of the government. So here are six of the terms that we looked at a few classes ago when we did the cost of debt. So in this case, the loan amount's $10 million, obviously an important term. Interest rate of 5%. Caution there is don't just judge one loan versus another based on this alone. It's an important factor, but it's a factor, not the only factor. Compensating balances, remember those? No? I hope so. Compensating balances are monies that you must leave with the bank as a minimum in order to have an account with the bank that's in good standing. So in this case, you borrow $10 million, you immediately put $10,000 into an account with the bank, and you keep that balance there all the time. It doesn't drop below $10,000. The importance is, in this case again, that you borrowed $10 million, but you didn't get $10 million. You got $9,990,000. So therefore, your interest, in this case 5%, is actually higher than 5, because it would be 5 on 10 million. but it would be slightly more if all you got was $9.99 million. Upfront fees, these are straight expenses that you must pay in order to get the loan. So these are called points, and a point is a percent. So in this case, 2 points equals 2% of the loan amount, or 2% of 10 million is $200,000. So that is a fee you'd have to pay upfront to the bank just to have the loan. Reimbursed legal fees. The bank may require you to pay their legal fees for writing the loan. And this is another one of the golden rule things. The bank says, okay, we're going to do this loan. It takes us quite a bit of financial due diligence and legal fees and legal filings, and therefore you pay those. And if you don't pay it, you don't have the loan. Annual renewals are sometimes seen in banks, and these are typically more for lines of credit, but they can charge you a number, in this case $50,000 per year, just to have the credit facility or the loan from the bank. So these are 6 of the possible terms in the bank loan agreement. We've touched on these before, but this is where you'd be very, very careful. While we're on this topic, there's this distinction between what's called a positive covenant and a negative covenant. First, let's start with the word covenant. Covenant just means promise. It's an old-fashioned word. That means these are the promises made in the loan document. So next, a positive covenant means I will do something. And a negative covenant is I will not do something. And what we've seen on these last 2 slides are examples of positive and negative covenants. For example, a positive covenant would be I promise to leave $10,000 minimum in the bank. That's a positive covenant. Or I promise to pay $50,000 per year to renew this agreement, or it won't exist any further. Those are positive. Negative is I will not take the bank's money or any of our money and make a special dividend payment to any of the shareholders. Or I will not sell substantially all the assets of the company without the bank's approval. So these are I will not do things, negative covenants, as opposed to I will do things, positive covenants. Next, we look at why ventures may not get debt financing. First is your startup, and your assets are intellectual property or know-how or perhaps your team, but they're not tangible assets. There's no factory, no land, no inventory, no receivables. Next is receivables themselves, even if you had them, may not have a lot of history. You may have customers, but they don't have a history of paying their bills to you. Or there are customers that have tried your product, but there may be a performance of the product question where they bought it, they have it, but they haven't yet accepted it. They will pay for it if they like the product and it suits their needs and the promises you made. So receivables are very risky, especially early in a venture's life. Bank's management might be necessary, but they can't do it. So there's a couple reasons a bank cannot get involved in helping their borrowers. First is that's not their business. Their business enables them to make loans and not be highly active in running the business or take much of their bank time and resources to help you run your business. And another more technical legal issue is they really cannot give major advice, strategic advice, because what if they told you to go left instead of right and you went left and the company went bankrupt? That would be overreaching the bank's responsibilities. They are now involved in dictating the strategy of company, and that's not why they're in this relationship. So a bank cannot act as a shareholder. The bank must act as a lender, or they will cross the line and perhaps not have all the remedies due to them under the loan agreement. And next, the risk characteristics might just not be there because the bank may not have that particular amount of risk in their investment objective, and it may not be in their capital ratios. So there may be technical and strategic reasons or just risk judgment reasons why they will not do this loan. So why would you use a credit card? Well, first, it's easy. You'll be offered credit cards in the mail. Like, oh, wow, thank you. Another $20,000 of credit. Be very careful, however. Then there might be potential low cost when you roll balances from one card to another. So they might have close your other accounts and roll into ours and we'll give you a lower rate. So that might be enticing, but watch out again because that rate might be for a short term and all they want to do is get you into their bank account with high interest rates. So be careful of these low rate interest offers. Next is personal guarantees may be required to get a credit card. You'll find that many corporate credit cards are written as if they're corporate liabilities, but the individual cardholder actually has a personal liability for that credit card. So they look corporate, but they actually turn out to be individual. So beware of the fine print when we're looking at credit cards, either for you personally or for the company.